Hi, I'm Dave Van Oss, Agricultural Markets Manager for Libro Credit Union. Libro is very excited to be this year's presenting sponsor for the Virtual Outdoor Farm Show. We truly hope that your farm business finds great value with this upcoming session.
Good day, everyone. I'm Mike Jubenville with Markets Farm out of Winnipeg, and thank you for joining us for a brief review of developments in the corn and soybean markets. Note that this presentation was recorded on Friday, September 11th, just a couple hours after the USDA supply-demand report came out. So we're going to go over some of the numbers and some of the expectations going forward. In conducting these various market talks that I've done with growers over the past 12 or 18 months or so, I've told growers that the year ahead was probably going to be one of survival mode in these troubled economic waters that we had been in. And in many ways, that's been true over the past 1 or 2 years. But coming into this summer, the broader market fundamentals appear to be changing. And in the past month of notable price rallies that I'm sure you've all been noticing, these are worthy of note. But to be honest, I'm feeling encouraged by the farm outlook ahead. I don't want to be a raving bull about what we may be seeing because there are many challenges and uncertainties that lie ahead this marketing year. But it would seem to me that we are entering a period of demand-driven bullishness in the grain markets, and something that we probably haven't seen for a few years now. So I suspect we are probably turning a corner here. So let's take a look at a couple of slides. And this one I want to put up just as one that I use when I'm looking at all kinds of markets, how the behavior they have done over the past couple of decades. I'm using soybeans, a monthly graphic here going back to 1991 as a startup. And I've always called this my 2, 2, and 2 philosophy. 2 years up, 2 years down, 2 years sideways. And what I have boxed off, there are periods of sideways that we've had, and you can see around 1999 to 2002 and 2004 to 2006. We've had periods of sideways range, and when we have a breakout from those sideways range, they tend to be higher, and we have a spike up, a spike down, and then a sideways period for a period of time again. And this, again, going back to 1991, has repeated itself a number of times. Now, I can remember talking to growers back in 2016 or so, 17, where we're going through the latest sideways range where I have, bracketed there by the blue bars on the graphic. Going into 2018, we had been in that period of sideways range for the better part of 2 years and thinking that the next opportunity we may have in these markets may in fact be to the upside. Well, lo and behold, the Trump administration in the United States started their trade war with the Chinese and created significant disruptions in the marketplace where geopolitics got involved in supply chains and such and created quite a disruption in the market. And you can see right around that time in July of 2018, we had a breakdown in the marketplace and we've been trading a lower range ever since then. I suspect that we may be in the process of finally looking at an opportunity to break out of that range again. Now, debate in the days ahead and have been on crop size and supply issues and such, but I think we're seeing a demand bull market that's starting to develop here. That's something, again, that we haven't seen in some time, as China has drained down their grain reserves in the midst of this trade war with the United States, drained down those reserves over the past 2 years. And you're hearing stories every day now that China keeps buying U.S. origin something or other, soybeans, corn, wheat, virtually every other day. And the cash markets have strengthened quite a bit as we've gone through the later stages of summer. And I find this quite an unusual time for markets to be rallying. This is a counter-seasonal time. Typically going into the harvest season, markets are eroding on the expectation of a new crop supply hitting the commercial pipeline. But that's not the case this year. And this situation is created by vibes that China has already cleared out Chinese soybean and corn supplies early this year, and the expectation of turning to the U.S. and a tightening available supply in the near term. Now, the demand bull, I think, is a rare event in the commodity space, and as long as the Chinese keep conveying this type of behavior, I think we'll probably need to get further along into the calendar before being concerned about crop prices entering any kind of sustained downtrend. I've been suggesting to my clients that after the struggle of the past 2 years, that in 2020 and 21, that market fundamentals and associated price prospects are probably looking more encouraging now. But if I had any advice for growers, is that to price something into these rising markets. Don't think that one can pick a top. We never know the fact of where the tops are until well after the fact. But if you're like me, I've been very comfortable when I see profitable pricing opportunities to incrementally sell into rising markets. I can sleep well at night as opposed to the alternative, waiting for a top and then chasing the tail of the market on the way down and the anxiety that it produces amongst all of us. So that's something, a little piece of advice I would say for now. But let's take a look at some of the issues here. I've got a graphic here from Kansas State University. That's their vegetative greenness, their biomass satellite intelligence that shows, I got circled here, the US Midwest. And this is actually a picture of about the beginning of September of last year. And you can see, in the Midwest areas, a lot of green, but there's also a lot of brown areas. Now, if we look at the picture of the situation today, or at least at the end of August, it certainly looks a lot of greener a year ago and the picture of today. So, certainly expectations of rising production relative to last year. But again, this is a picture from about middle of August into the end of August, and we know that the heat and dryness issues that affected the Midwest, especially western areas like Iowa, have been quite pronounced during the course of August. So if we look in the latest biomass graphic, again, this is to August 31st, but in the latest one has turned a little more yellow. So those expectations of what yield are for this year have certainly been curtailed with some of the heat, windstorm that blew through Iowa and such that are garnering a lot more attention. So yield estimates are declining because of the derecho windstorm in August, persistent dryness. And if we look at, in the case of the U.S. Drought Monitor, going back to the beginning of August, you can see that areas of dryness in the far west of the United States, but you see Iowa with a little dab of extreme drought conditions back at the beginning of August. But by the end of the month, or at least the September 8th, dryness issues have picked up in those western states through the Dakotas into Nebraska, and certainly, again, dry areas in Iowa that have spread across the northern parts of Illinois and into Indiana. So this is something that markets have been paying attention to and has been the source of some of the rally that we've seen in the past month. So let's take a look at the soybean market. If we look at USDA crop condition indexes in the case here with Iowa, and remember there's had some pretty significant dryness issues there, certainly on the western part of the state through the central areas. Crop conditions relative to years past have fallen quite dramatically in August, where there's maybe, instead of 77% good to excellent rating for the soybean crop back at the earlier in the summer, now we're down to about 44% or so. So this is certainly something that I've taken notice in the marketplaces. And the overall U.S. soybean conditions have deteriorated overall, maybe a little less so than the dramatic results we've seen in Iowa. But other areas to the east of the eastern areas of the Midwest and down into the southeast U.S. Crop expectations are still quite high. So that's been a bit of an offset, but still overall still deteriorating conditions that we're seeing in the crop there. Soybean production. This graphic represents the major players in the international marketplace, Brazil, Argentina, and the United States. So we're seeing crop prospects that in the United States are probably, as of today's USDA report, on the area of about 4.3 billion bushels or 117 million tons. That last bar is representing that crop for the United States. For the Argentinian and Brazil crops, those are guesstimates for the year ahead. So they're very preliminary kind of numbers, but an expectation that Brazil, given the incentive financially for growers to put in soybeans this year, with the acres intended, could be a record crop in Brazil next year of 130 or so million tons. Argentina, maybe about 50 or so million tons or so. So those are actually before the crop's even in the ground ideas. So, there's still a long way to go, and we'll be debating those numbers as the growing season down in that region progress through the fall and into the winter season. Now, in terms of U.S. soybean production, again, 4.3 billion bushels is what USDA projected for today, tailoring back some of their yield expectations from their month ago report. Still a big crop. It's not like we're going to be running out of soybeans anytime soon per se, but it is a bigger crop certainly than that was produced last year when we had a late crop getting in the ground and a wet harvest season. That's, I'm sure, a lot of growers in Ontario are familiar with and experienced that same result last year as well. But this year, production prospects certainly are looking better, but down from where they were a month or two ago. The real interesting thing here on the soybean market is on the demand front. And again, I want to reemphasize the point because I don't know if this idea has really gained a lot of traction yet. And we know there's been big sales to China, but I do believe we're seeing something quite unique here in terms of a demand-driven marketplace that is moving quite strongly. And heading into the new crop market year, the forward book for U.S. new crop soybean sales is probably the largest on record we've seen right now. They're only about a week and a half into their new crop marketing year, but already there is about 30 million tons of soybeans that are already been booked for sale for shipment through the fall and into the winter times. And a good portion of that is coming from China, certainly, but the aggressiveness of that buying is quite interesting. And as China alone, once we get even to the end of this calendar year, the end of December of 2020, China could be in and of itself have purchased about 30 to 35 million tons. So there is some very aggressive buying interest that's at play here. The question is, where is it coming from? Is it coming from the phase one trade agreement that the Chinese and the US had signed earlier in the year? Or is it a matter of just the US needs those beans? And quite frankly, given that China has bought out all available Brazilian and South American supplies over the past 6 or 8 months, it's telling me that this isn't about China trying to do a favor and living up to the trade agreement. It's probably more to do with the fact that they just need those beans. And they've driven down their stocks of wheat, of corn, of soybeans, and oilseeds generally, that they need to replenish those supplies after going through a period where they're rebuilding their hog herds after African swine fever and other issues that have driven down their available supply. So I think that there's a lot of momentum here on the buy side, and I suspect that's probably going to be continuing right into the winter months. Now, ending stock expectations, USDA today revised lower from about 610 million bushels down to 460 million bushels for the new crop marketing year. So again, would not be an historically tight stock scenario for the United States. It's still about the fourth largest ending stock expectation that we've seen on record in the US, but the trend certainly is tightening up rather quickly. But demand is still the key for the soybean situation as we progress through this year. With the trimming of US yield and in turn production amid this surging demand from China, the changing dynamics of the marketplace are taking hold, I think, in the soybean market. And we're trimming the market's perception that there was an oversupplied market, probably something that's more of a moderately supplied marketplace. So let's look at the trend here we've seen on soybeans. Again, these graphics were put up here on Friday, just after the USDA report. Upward facing dog, not a technical term for the chartists, but my wife is a big practitioner of yoga and seems to fit with the price trend that we've been seeing with soybeans these days. To be honest, I think I'd probably hurt myself if I tried one of these moves. But soybean futures have been in an aggressive rally mode. They're testing here on Friday as this report is being recorded, the $10 a bushel level. This is the highest prices we've seen of all of 2020. It's been an impressive rally, over $1.25 a bushel over the past month as this heat and Midwest dryness and strong winds that have whittled down U.S. crop prospects to some degree. And again, just happening at the same time that Chinese buying interest in the past 6 weeks have really gained some impressive momentum. Demand on the U.S. crusher side is remaining at record levels on a month-to-month basis. So we're seeing demand driving the marketplace and elevating these prices. Now, that said, how much of this bullish news that has already been factored into this marketplace? Well, like I say, the trend is up, certainly. I get a little concerned if we start going up a little too far too fast, then we could have corrective measures, and we certainly will see corrective action, especially going into the harvest season. First support probably around that 950 area, but even if we got down to the 920 at second area support, the overall trend for soybean market is still higher. We've just been moving so aggressively higher over such a short period of time. On the weekly graphic, we are looking at the highest price levels since the very start of the US-China trade war here. And again, we should note that over the winter and spring and into the summer, China has flushed out the Brazilian soybean supply to the point where users in Brazil are reportedly being forced now to import soybeans, already pulling some from neighboring countries like Paraguay and such, but they're looking to potentially reduce import tariffs to allow even US supplies into the marketplace. So US soybean supplies, even at these elevated prices of today, are actually very price competitive on the international market. So like a FOB Gulf soybean price today is probably about 50 cents a bushel, still cheaper than at Brazilian port, as their supplies have been dwindled quite strong. So this is fueling a very strong US export sales program, even in the midst of a rallying price, because really the US is the only game in town right now. Historical patterns, this is where I find something very unusual. This is the seasonality patterns for the soybean market, and the furthest to your left on the furthest left block from July to October, usually soybean prices are in the midst of a downtrend as we get into harvest lows, and once we get past the harvest season, then have some rebound in pricing. But this year is very different, very counter-seasonal. So how we shape up, maybe the seasonals have come into play earlier this year, or we have momentum to go the upside, but I suspect we'll probably have some kind of corrective measures of some sort going into the harvest season. But at the same time, the demand element of the marketplace looks quite strong and likely able to support the markets quite well, I think, going into this new crop marketing year. Next up is going to be the shifting market focus towards South America. The planting season there for soybeans and corn is going to start picking up in earnest in the next number of weeks for Brazil firstly, and then down into Argentina as we get later into the fall season. Dry issues, as you can see on the graphic here, are already creating a bit of market chatter, especially with the U.S. Climate Prediction Center just this week confirming that La Nina conditions are present, and they gave about a 75% odds that these La Nina conditions are going to continue in the months ahead through our fall and into the winter seasons. Below average sea surface temperatures that are extending across the central and eastern equatorial Pacific Ocean raises the odd that heat and dryness in southern Brazil and Argentina are probably going to be in play. Now, the tendency of this actually occurring is not absolute because it's a moderate La Nina instead of an extreme, but dryness here certainly would be bullish within the context of the global oilseed markets if we get later into the winter months, if there are concerns, delayed plantings at first and foremost in northern areas of Brazil, but certainly this could be something important, especially when the market is already expecting a record large Brazilian output in the year ahead. So too soon for the markets to get really geared up on this issue, but yet we can't, really dismiss that potential of a looming risk that sits there. Such a development would foster, I think, more risk, more fear, and probably a tendency amongst export users to want to extend their export purchases from North America and maybe extend it further out when would normally be the case from September or October on to December, January. Normally, maybe the buying from North America goes all the way out into February, March, when typically we would expect new crop South American supply to basically take over the marketplace. But this may be a little bit different a year. Okay, let's take a quick look at the corn side. Again, looking at Iowa conditions, especially over the past month, but since about middle point of July, crop conditions in Iowa, what is rated good to excellent has been falling down into that 40% range. Certainly looks a significant setback relative to what we've seen in past years. Dry Midwest, that August windstorm created significant damage through the state of Iowa, major corn producing state obviously, but has also impacted areas like the South Dakota, Nebraska, and even over into Illinois as well. So this is certainly a market issue that has garnered a lot of attention. StatsCan here in Canada is saying corn output at about 13.92 million tons this year overall for Canada. It's probably the largest crop since 2017, but not enough to change the market perspective from the broader perspective. U.S. corn conditions overall, again, you see that there's been some offset of some of the better producing states from the problems that we've seen particularly focused upon Iowa, but overall crop conditions have been deteriorating this year and over the course of the summer, and we've seen a correction lower in what has been expected from USDA. They today, here on September 11th, put production at 14.9 billion bushels. That's down from about 15.3 billion that they had in their August report. So you're seeing some curtailment take place there. Again, here's the production numbers with the red bar highlighting this year's crop, again, 14.9 billion bushels. Here again, similar to what we've seen on the soybean side, exports have been, for this time of year, the beginning of the new crop marketing year has been quite dramatic. In excess of 18 million tons has already been committed for export this year. So much of the anticipated crop production loss is probably already factored into the marketplace for corn right now. We'll see in the months ahead what revisions may yet entail as we get into the harvest, but demand certainly is providing leadership in the current market and helping lift the market. There is a rising speculation that China, not only on soybeans, but is going to hike its corn imports dramatically this year, needing to much more corn than anticipated after we've seen some frequent flooding, 2 typhoons that have damaged corn crops in China. Images and videos are showing wind flattened corn and have been making the rounds on the internet. Now the China tariff rate quota, where they have a low tariff on imports of corn, like at 1%, comes in at about 7.2 million tons. And after that, a higher tariff gets applied to any additional corn coming in. That's really limited the ability to ship corn in the past. But there was a senior trader with Louis Dreyfus in China earlier this week that was suggesting that China may need, because they've drawn down their corn supplies so dramatically over the past couple of years, especially during the trade war with the United States, they may need in excess of 30 million tons of imports this year to satisfy what their requirements are going to be, which would be a huge amount of corn. And in USDA supply-demand balance sheets internationally, they're still only showing China at about 7 million tons for the entire new crop marketing year. Well, they've already almost have that on the books now. So there is an expectation that corn, the need for corn in China is going to be rather dramatic. Some of that is going to get supplied by other users like the Black Sea region, Ukraine and such. But the demand from the United States certainly is quite significant for this year. Some of that is being offset by some of the problems that are still lingering with the ethanol industry in the United States. But we have seen certainly a resumption from the initial COVID loss of the ethanol demand and fuel demand in the United States. That is recovering, and on the feed side, I suspect we're probably running at similar levels that we have in the past year. So the export side really is the one that's gaining a lot of attention in the marketplace. Corn ending stocks. Right now, the projection is that we've had some contraction in this latest report. This number was 2 months ago projected to be over 3 billion bushels, which was a huge bearish potential catalyst for the corn market. But with some contraction of production expectations for this year, along with some surprise demand that we're seeing on the export front, we have been seeing last month down to 2.7 billion bushels. Now it's 2.5 billion bushels for the year ahead. The U.S. is not short of corn, but again, the idea is that demand is, as we're entering, I think, a demand-driven marketplace more so than we've seen in the past 2 years, especially on the export front, that ending stock supplies certainly are in some element of contraction here on the corn. So looking at the corn market, also in the midst of August and into September, we've seen the speculative funds move aggressively this summer from holding a very large net short position in Chicago corn futures to now transitioning into building a long position in the marketplace as these production ideas have been eroding and carryover forecasts have been coming off what was initially very bearish looking ideas. So December corn futures now have moved above the July double top and above the August 31st high, and are now pushing into the highest prices we've seen for corn since probably back in March. The trend is up and is expected still to continue, but not without correction. After all, we are starting to get into the harvest season soon, so there will be fresh new crop supply coming into the commercial pipeline to weigh on things. But right now, the support levels for corn to me at on the December contract at 353, and then there's the gap down there at 346. There is room certainly for accelerated gains until and unless that market seems to really test and clear back below these kinds of levels. The trend in corn, at least at the present time, certainly is higher. Again, not one to suggest that one should be scaling sales into a rising market, but right now the trend certainly is tending to be higher. What's the upside opportunities here? Well, I look at a weekly chart on corn, 370, and we're not that far away from it, and have got there in a hurry over the past 4 weeks after testing down $3 December corn futures for a while. We're pushing towards this first area of resistance at 370. The major area of resistance in my mind is in that $3.90 to $4 a bushel area. So prepare yourselves for opportunities, looking for good basis levels available in your local areas, and looking for a chance to start a process of scaling sales into this marketplace. Okay, that's the brief wrap up that I have for soybean and for corn market perspective. I appreciate you taking the time to visit with us today. I hope you have a bountiful harvest season and stay safe out there. Thank you.